Hey, significant tax reform was signed almost a year ago. Do you know what it is? Do you know how it's going to help you? Are you going to pay more tax, less tax? You only have a few months to get end-of-year tax planning done. That's what today's show's all about, folks. Welcome, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Big Al Clopine. He's sitting right over there. He's the CPA, so he's going to steal the show today. Both Big Al and I work for a great company. It's called, boom, Pure Financial Advisors. When you're looking at this time of year, yes, Thanksgiving, the holidays, and everything else, but don't forget about your taxes. Almost everything that you can possibly do to save money on taxes needs to be done before the end of the year. So we're going to break everything down for you today. That's what we want to get into. That's today's financial focus. Hey, this is by the Internal Revenue Service. I found this extremely interesting. Right here, top 50 wage earners pay 97% of tax. If you flip that, look at the reciprocal of it, that tells me that half of individuals here in the U.S. do not pay tax. Half do not pay tax. So when you hear all of the jargon out there is that you'll be in a lower tax bracket in retirement, they're talking to the masses. For people that have saved a few dollars, guess what? They're not talking to you. When you look at this statistic here, the top 5 or the top 10, you might think, oh my gosh, these people are making several $100,000 a year. To be in the top 10% wage earner in the country, you're making about $130,000 a year. If that's you, you're picking up the tab for about 70% of all taxes. This is what we want to dive into today. This is what show is all about to save money in taxes. Because here's the deal. If you take a look at this quote, I'm not going to read it to you, but I'm going to paraphrase. It is our given right as U.S. citizens to do everything possible to reduce our tax bill. Everything possible to reduce our tax bill. But how do we do it? We have to be educated. And who better to educate us is Big Al Clopine. Let's bring him in.
This has got to be one of my favorite topics, is saving taxes. So this is year-end tax planning. You got to do most of these strategies before year-end. And so we're going to talk about strategies for employees, for investors, for retirees. And we want to spend a little bit of time on creating tax-free income, because who wouldn't like tax-free income in retirement? And Joe, this is our favorite topic, right? Taxes.
Ours, maybe yours.
I mean, mine.
Yes.
You're getting to like it.
Oh,
there.
yes. When you look at saving taxes, Alan, we got to look at employees, because employees only have certain options, right? If I'm a small business owner, if I'm an investor, if I have assets, there's other strategies that you can potentially do. But if I'm an employee, I only got so much that I can work with. Right.
And so let's start with retirement plans. So IRA right off the bat. So there really wasn't a change there with the new tax law. It's still $5,500. And if you're over 50 and older, it's $6,500. It actually goes up in 2019, so be aware of that. Simple IRAs, $12,500 if you're in a corporate plan that has a simple IRA. And if you're 50 and older, it's another $3,000.
401k plans. So if you look at your 401k plan, you might have to just defer 100% of your salary if you're trying to max it out. So just take a look to make sure, hey, how much have I put into the overall 401k? Because just know that you can put in about $18,500. And if you're over 50, there's a catch up. So close to $25,000 if you're over 50. So look at where you are. And a lot of times where people make mistakes, Al, is that you're over 50 and you didn't know that you could elect for the catch up. You thought it was automatic. So double check. You think you fully maxed out that plan, but you might not even be in the catch up provision within the overall 401k plan.
Well, that's exactly right, because as you say, you think you've done it, but you haven't really. And then, of course, if you're the business owner, you can put more than just that $18,500. You can put a lot more. It's actually up to $55,000 for a plan, depending upon your income level. And be aware, if you are self-employed, you can actually set up your own plan. It's called a solo 401k. You got to get that plan set up by December 31st, but you can fund that with an employee portion. In other words, your employee and employer both, so $18,500 plus a profit sharing amount. So it can be a pretty big amount, Joe.
So when you look at right now and the changes that happen within the overall tax code, I would say probably on the individual side, two huge changes happen. The standard deduction is one. For single and married couples, it basically doubled. Because here's what the thought was, is that, all right, well, let's look and let's try to simplify things. And so if we have a standard deduction of $6,000 for married or $6,000 some change, let's double that to 12. And so married couples, it was around $13,000. Let's double that just about to 24. So that increased the standard deduction. So you can either take the standard deduction or you can itemize. So you take whatever is higher. So they're saying if I increase that overall standard deduction, then maybe most people would just take the standard and they don't have to worry about filling out the Schedule A. That actually hurt a lot of people here in California of how they changed the itemized deductions, Al. So I think a lot of people across the board might save a lot of tax, but in high tax states, it probably hurt them a little bit because of how they changed the itemized deductions.
Well, they did, and you probably have heard about this, is that if you're in a high tax state like California, New York, New Jersey, you might not be have done as well as you thought under this new tax law. And the reason is because state taxes and property taxes were now limited to $10,000. In other words, that's your total deduction. Even if your taxes are $50,000, whatever it may be, you can only deduct $10,000. So that's a really big change. And as a consequence, Joe, a lot of people are not going to be itemizing anymore.
Right. Is that, all right, well, here, I was paying $10,000 in property tax and another $30,000 in state tax. I can only do $10,000. All right, well, that was my biggest deduction. So now I'm just going to take the standard. Another thing, if I'm charitably inclined, they changed the rules there a little bit to kind of enhance it. It's now 60% versus 50. But there's a double-edged sword here because, right, if people are filing the standard deduction and they're not itemizing, they're not giving as much to charity because they potentially can't write it off on their tax return.
Well, that's true. And so let's just think about this logically. If you're using the standard deduction, then if you do a little bit more to charity at year end, you're getting zero tax benefit. So what a lot of people are doing is they're bunching their charitable deductions. Maybe they're taking 2 years and doing it all in 1 year so that they have enough deductions to be able to itemize. Or maybe they're setting up a donor advised fund, which you can actually put money into, and they take the tax deduction the year you put the money in, but you can then dole it out as you see fit in future years.
So here's the changes, right? So now what do you do with these changes? What we want to get into after the break is really to break down 3 or 4 specific strategies that you can implement before year end to save money not only today, but also in the future, because this is key. There's some things that you absolutely want to do because the marginal rates went down. You have to take a look at your capital gains rates. Does a Roth IRA conversion make sense? We're in volatile stock markets, so does tax loss harvesting make sense? Do you even know what that is? What I'm going to try to do with Big Al here is we're going to break things down for you so you can understand the strategies, and then hopefully you can implement them before it's too late, before the end of the year. If you need any more resources or any help, always go to yourmoneyorwealth.com. What we have is our 2018 tax planning checklist. It will give you a full checklist of all the things and strategies that we're going to talk about today and so much more. So go to yourmoneyorwealth.com, click on that special offer, download the tax planning checklist, and get your tax planning in order. We got to take a short break. We're just getting started, folks. Show's called Your Money, Your Wealth. Hey, welcome back to the show, folks. Show's called Your Money, Your Wealth. Joe Anderson, Big Al hanging out here talking about end-of-year tax planning. We're going to get into strategies that you can implement before year end. But before we do that, let's see how you did on the true-false question.
A short-term loss created by selling a mutual fund cannot be used against a long-term gain created by selling another mutual fund. That's false. And I think a lot of people miss that because they think it's only one or the other. Here's how it actually works. On your tax return, short-term losses net with short-term gains first, long-term losses net with long-term gains second. And then if there's still excess of either one, you can use that. You can use a short-term loss against a long-term gain or a long-term loss against a short-term gain. So be aware of that when you're thinking about your tax planning.
Let me break this down for you. When you look at investing, let's say you have $100,000 invested and the market takes a dive. And then now you're down, let's say 20%. This could happen in a week, this could happen in a year, this could happen in 5 years. If it happens in a week, that's a short-term loss. If it happens a year and a day, that's a long-term loss. A loss is just a loss. So now I'm down 20%, and so now this is worth $80,000. So what usually people do is they either sell this and get the heck out of the markets. Well, good for you, you created a loss. But I want you not to do that. I want you to take another step forward. This concept is called tax loss harvesting, and it's extremely important in volatile markets because it can have a huge impact on your overall taxes. So this $100,000 is now $80,000. I lost 20% or 20 grand. So $20,000 is my loss, right? But I'm not selling this and going into cash. I'm selling mutual fund A, let's say, and I'm buying mutual fund B. Let's say this was the S&P 500. I'm going to sell that and buy the Russell 2000 index fund. So I'm still in the market. Now, when that asset comes back up because the market recovers, I have 100,000. I bought and sold at this particular time. I still potentially have $100,000 if this was back in 2011. But what did I do? I created this $20,000 loss. This $20,000 loss can offset against any future gain in the future. So as I'm trying to create income long term, I have these losses to offset gains. And so when markets are crazy volatile as they are, you can look at buy, sell, and you can do all sorts of cool tax strategies, and you can make lemonade right out of lemons. Is that the saying, Big Al?
That is the saying. And I think a lot of people kind of mix this up. They think the loss is limited to $3,000. That's when you already use up all those losses dollar for dollar against other capital gains. If you still have losses, you get to take $3,000 against ordinary income like salary. If you have more losses after that, it carries forward indefinitely. So it's a concept that can save you money in the future. Another one is tax gain harvesting. It's just the opposite. So now this is when you're low tax brackets, and when you're close to $40,000 taxable income for single, close to $80,000 for married, then when you sell a stock, a long-term stock capital gain, you actually pay zero tax. You may pay state tax, but you pay zero federal tax. Quick example. So let's say you're married, taxable income's $50,000. You can actually sell about $27,000 worth of gain to get to that $77,000 threshold. You'll pay zero federal tax. This is particularly useful if you need to rebalance or you need funds and you're afraid to sell them because you're going to pay tax. Well, guess what? You may not have to pay tax in that situation.
Yeah, you have to take a look at your tax bracket, right? Because look at taxable income, line 43 on your tax return. So if you're $80,000, if you're single or married, $40,000 roughly, there's zero capital gains rates here. So for those of you that are retired, that are living off of your assets, really start taking a look at this, because if you have gains, like Al said, you can sell up to these thresholds and pay zero tax. If you really like the security, sell it and buy it back, because you're just increasing your overall tax basis. Now, this only really, we're talking about assets in this category here. So this is outside of a retirement account. That only works for assets outside of a retirement account. So we call those like taxable assets. But I understand that a lot of your assets are sitting in this pool here, tax deferred. So that's your IRAs and 401ks, 403bs, TSPs, and so on and so forth. Very few people have this guy. That's the tax-free pool. That could be a Roth IRA, right? So what we look at is to try to get diversity. We all understand diversification, stocks, bonds, real estate, precious metals, but there's very little tax diversification going on in your overall situation. Because if all of my money is sitting in this account, every last dollar is going to be taxed at the highest of rates, ordinary income. But guess what? The tax code has changed. Those ordinary income rates are probably one of the lowest they've ever been in history. So it might make sense to take a little extra out of these accounts over the next couple of years just to pay the lower tax. Better yet, you might want to put them up here into a tax-free environment. Yes, you pay the tax going up here, but you have to look at what tax bracket are you in now? What do you project to be in the future? Does it make sense to have assets to forever grow tax-free? The answer is probably yes, because this is how tax rates work. They stair-step. So last year we had a 10%, we had 15, we had 25, 28, 33, 35, And then this top one, 39.6. You get the gist. But this 15 turned to 12. This 25 turned to 22%. This 28% turned to 24. As you can see, these are huge tax savings that we can implement. So when you're looking at, hey, should I take money from this account and move it up here? The answer could be yes, because the tax rates have changed. They are a lot lower, so you're buying the tax on sale, and you're going to have those assets to forever grow tax-free. Now you have to start taking distributions from the overall account. I'm going to start taking money from my tax-deferred account. It's ordinary income. So then I fill up these lower brackets, right? I'm going to fill up the 10%. I'll fill up the 12 or 15%. But I want more income, right? I want more cash flow. So what do? If I've prepared, I'm going to take it from this tax-free guy, pay zero tax. So the point is here. Now, I'm living up in these high tax brackets, but I'm paying very little in tax. Does this make any sense whatsoever? Absolutely it does. You love this stuff. We got to take a break. Go to yourmoneyyourwealth.com, get our tax planning guide, and it's going to make all of this make perfect sense to you. Hey, welcome back to the show, folks. Show's called Your Money or Wealth. Joe Anderson here with Big Al Clopine, hanging out, talking end-of-year tax planning. We're going to flip the show to you, answer some questions, get some rapid fire, wrap this show up. Before we do all of that good stuff, let's see how you did on the true-false.
A qualified charitable distribution allows me to give directly to charity from my IRA and have it count towards my required minimum distribution. And that's a true statement. The QCD, Qualified Charitable Distribution, it's a pretty new concept. It's only been around about 5 or 6 years. So you have to be 70 and a half, and then you can give directly from your IRA directly to charity. You never get the money. It goes right to charity, and then it can count towards your required minimum distribution. It can be up to $100,000. It can be higher than your required minimum distribution. It can be lower, but it does count for your required minimum distribution if you're charitably inclined and you can't itemize because the itemized deductions are lower and you're 70 and a half. This is a great way to get some tax benefit because you don't have to count that income on your tax return.
Hey, what's the benefit of that?
Well, the benefit mainly, like let's say, Joe, for example, the married couple standard deduction is $24,000 plus another $2,600 or so, mainly because they're over 65. So then in this case, if they give directly to charity, they're not going to be able to take the deduction because they don't itemize anyway. So here, if it comes right out of the IRA, they don't have to have a required minimum distribution counted as income on their tax return.
So it's a kind of a double whammy. They can take the standard deduction, they can still give to charity. That doesn't show up on their tax return. That doesn't add to income tax. So the deduction doesn't necessarily matter because it's the income's not even going to show up on the return.
Exactly right. Yeah.
So QCD, Qualified Charitable Distribution.
Right.
Is that what it's called?
That's what it's called.
Is it time to ask the experts? Is that what's going on now?
It's time for rapid fire.
Is it rapid fire? Let's get into some rapid fire.
Let's do it because there's a bunch of strategies that people need to know before year end. And the first one, we've already kind of touched on this, but it's to maximize your retirement plan contributions that are available to you. Now, if you have an employer that has a 401k plan, you can give up to $18,500 of your own salary to that, $6,000 more if you're 50 and older. Now, if you have an employer that has a simple IRA, now it's $12,500. And if you have an employer that has nothing, then you can do a regular IRA, which is $5,500, or $6,500 if you're 50 and older. The simple IRA, the 401k, Joe, have to be contributed from your salary by December 31st.
So it's pointless to even talk about it because it's way too late.
Not too late at all.
Next rapid fire.
Next one is consider charitable strategies. And Joe, this really is one that you can make a difference on your taxes between now and year end, because it's the charity that you give before year end that will count on the 2018 tax return. And a couple things you might consider. This first one, it's called what we call bunching donations. So this is where, you know what, you may not have enough deductions to itemize this year because the standard deduction is higher. So maybe you take a couple years of contributions and make them at one time so that you have enough deductions to itemize. So that's one way to go. You could also use what's called a donor advised fund, DAF for short. That basically, it's an account you set up that you put money into, and then you dole out to charity slowly over time as you see fit, but you get a tax deduction the year that you put it in. And Joe, we already talked about key CDs.
Hey, a couple of things with the medical expense is that it's 7.5% of AGI this year. Next year, it's moving up to 10%. So if you have that last-minute medical procedure, call your dentist, get that hip replaced, do whatever you got to do this year, because the threshold is going to be a lot higher next year. So potentially you want to try to jam as much as you possibly can the next few weeks.
That's right. And you would call your dentist for a hip replacement?
Call your dentist or your doctor. Your dentist does a hip replacement.
Just wondering. Here's the next one,
Yeah,
Joe.
same with your barber, too.
Yeah. So review your investments outside of retirement accounts, right? See if they've gone up in value, see if they've gone down in value. If they've gone down in value, you've got an opportunity to do tax loss harvesting. This is where you actually sell a position. You buy something similar, so you're still in the market, but you create a tax loss that you can use against other capital gains. Sometimes you want to do tax gain harvesting because you're in such a low tax bracket that capital gains rate is actually 0 when you're in the lowest two brackets. And Joe, this is one I think that's missed all the time.
Yeah, I mean, right now, too, I mean, we have a crazy volatile stock market. There's probably positions that you have, if it's sitting in a brokerage account, that might be at a loss. If it is, sell it, buy something similar to make sure that you capitalize on the loss. Stocks go up and down rapidly. We're seeing some significant more volatility. So take advantage of the markets from a tax perspective. And finally,
Roth Conversions is yet another one. So we can still do Roth Conversions. Fortunately, that's where you're taking money out of your IRA, 401k, converting it to a Roth IRA. You got to pay tax on what you convert, which still works. Now the tax rates are lower. So for many of you, this is going to maybe be the best year ever to consider conversion. But here's the caution, is that recharacterizations or do-overs, if you will, you can no longer do those. So you cannot recharacterize. So once you do a conversion, it's irrevocable. It means you cannot change your mind. So when you do conversion, make sure it's the actual amount that you want to do, because you can't change your mind later, Joe.
And then now, finally, for small business owners, what do you got for them, Big Al?
Well, there's all kinds of things. There's pretty high limits in terms of buying equipment. Section 179, it's $1 million. So you can, if you have equipment needs, you can buy that between now and year end and take that right off. But there's another big one, which is basically the QCI, Qualified Business Income Deduction. 20% of your business profit may be a deduction. So make sure you check that out. It's pretty complicated. We're not going to go over it right now, but just be aware there's a pretty good deduction available.
Yeah, without a doubt, if you're a small business owner and if you're not familiar with the new tax code and how it's going to affect your tax return, you have to see a qualified professional before the year end. This is huge. It could be significant tax savings. So if you're a small business or if you own real estate, the whole new qualified business income deduction, 20%, is significant, because when that thing phases out, you lost a huge opportunity to put some tax dollars in your pocket. Now, let's go to Ask the Experts. We got a couple of questions here, bud.
Hey, Joe. Now, how do you determine your required minimum distributions?
It's a common question, and when you're at 70.5, you have to take those required distributions. Joe, why don't you start out with when you need to take that first required distribution?
Yeah, a couple of things. Well, first, I think the IRS code, what is it, Pub 590, is going to tell you your schedule depending on how old you are. You have to start taking your required distribution. Your required beginning date is April 1st the following year after you turn 70.5. That's the requirement. If you wait that long, then you have to take 2. It might make sense to take it the year you turn 70.5, or you can push it the following year. I think we have time for one more quick question.
I just started a new business as an independent contractor, so money is tight. Is there a problem if I will pay taxes at the end of the year rather than paying them quarterly? This is from Kay in Pacific Beach. And I'll answer that. Kay, you might have an estimated tax penalty. It's pretty low. It's 3% interest rate. So there could be a penalty. They want you to pay it quarterly. But if you simply can't afford it, it's not going to be that big of a deal.
So here's the pure takeaway today. Hey, now is the time to get some tax planning done. If you waited this long, it's not too late. Just go to yourmoneyyourwealth.com. Click on that special offer, folks. It's a tax planning checklist for 2018. It gets you in the details of all the things that you might want to take a look at to better yourself tax-wise. And that's it for us. For Big Al Clopine, my name's Joe Anderson, and you just watched another phenomenal episode of Your Money, Your Wealth. Have a wonderful weekend, and we'll see you next time.